What if the biggest financial mistake you could make in 2026 is waiting too long or buying too soon? Mortgage rates are still elevated. Home prices never had that dramatic crash millions were predicting, and yet right now, millions of Americans are lying awake at night asking the same question. Is this finally the year to buy? The stakes could not be higher. We are talking about a decision that could save you or cost you tens of thousands of dollars over the life of a loan. And with so much conflicting information out there, it is easy to feel paralyzed. But here is the good news. By the end of this video, you are going to have a clear, data-backed answer built specifically around the 2026 housing market. No guesswork, no hype, just the honest breakdown you actually need to make a smart move. And here's the thing. If you have been trying to figure out what is actually happening in the housing market, you are not alone in feeling completely confused. Turn on the news, and one expert is telling you to buy immediately before prices climb higher. Scroll through social media, and another analyst is warning you to wait because a crash is coming. The headlines keep flipping, the predictions keep changing, and the average person is left standing in the middle wondering what on earth they are supposed to do. It is genuinely overwhelming, and that confusion is costing people real money every single day they delay making an informed decision. So here is what this video is going to do differently. We are cutting through all the noise, skipping the fear-based headlines, and giving you a straightforward, honest, data-backed breakdown of exactly what the 2026 housing market looks like right now. That is the crisis millions of buyers are still carrying into 2026. Back in 2020 and 2021, the pandemic triggered one of the wildest housing surges in American history. Remote work exploded, people wanted more space, and mortgage rates dropped to historic lows, sometimes below 3%. Demand went through the roof while supply stayed frozen. Home prices jumped over 40% in just a few years in many markets. Then the Federal Reserve stepped in. To fight inflation, they raised interest rates aggressively, pushing mortgage rates above 7 and even 8% by 2023. That move cooled demand, but did not crash prices. Sellers refused to give up their low locked-in rates, so inventory stayed tight. Before we go any further into the data, I want to take a quick second to speak directly to you. If you are finding this breakdown valuable, if you appreciate getting real numbers, honest analysis, and clear guidance on one of the biggest financial decisions of your life, then this channel is built exactly for you. We cover real estate trends, mortgage updates, and personal finance strategies on a regular basis. The housing market does not stay still, and neither should your knowledge of it. Every rate change, every inventory shift, every new policy update could mean thousands of dollars in your pocket or out of it. So if you have not subscribed yet, hit that subscribe button right now and turn on notifications. That way, you will never miss an update that could genuinely change the outcome of your home buying journey. Now let us get back into it. So let's talk about mortgage rates, because this is where so many buyers feel the most uncertainty heading into 2026. As of right now, the average 30-year fixed mortgage rate is hovering somewhere between 6 and 7%. That's still significantly higher than the historic lows we saw back in 2021. The Federal Reserve has made some cautious cuts, but nothing dramatic enough to bring rates back down to levels that feel comfortable for most buyers. Leading economists are projecting modest relief throughout the rest of the year, with some forecasting rates could dip closer to the low sixes by late 2026. Now here's why this matters so much. On a $400,000 home, the difference between a 6.5% and a 7% rate is roughly $100 per month. That adds up to over $36,000 across a 30-year loan. Small numbers, massive impact. Now let's talk about what's actually happening with home prices, because this is where things get really interesting. Nationally, prices have not crashed. In fact, many markets have continued to see modest appreciation. But the story varies dramatically depending on where you look. In coastal cities like San Francisco, New York, and Miami, prices remain stubbornly elevated, making affordability nearly impossible for average earners. However, shift your gaze toward the Midwest and inland Southeast, cities like Columbus, Indianapolis, Kansas City, and Memphis, and you'll find a completely different picture. Prices in these markets have either stabilized or grown at a much slower pace, meaning buyers can still find genuine value. Some of these areas even saw slight price corrections in late 2025, creating real entry point opportunities. The takeaway here is simple. The national headline number doesn't tell your story. Your local market does, and that distinction could mean everything for your buying decision. Before we go further, here's a quick but important reminder. If you are finding this breakdown valuable, this channel is dedicated to giving you exactly this kind of content on a consistent basis. This channel covers topics related to the US and the global economy, and we upload a new video every week. So, if you have not subscribed yet, now is the perfect moment to hit that button. Turn on notifications so you never miss an update that could directly impact one of the largest financial decisions of your life. We would love for you to be part of this community. Now let's talk about something buyers have been desperate for: more homes to choose from. Housing inventory in 2026 has shown meaningful improvement compared to the historically tight supply seen in 2021 and 2022. More sellers are finally listing, and new construction has picked up significantly, with builders ramping up production to meet long-term demand. This added supply is slowly shifting the balance of power. Unlike those ultra-competitive years where homes received dozens of offers within hours, many markets today are seeing longer days on market and more room for negotiation. Buyers are increasingly able to request repairs, closing cost contributions, and even price reductions, things that were nearly impossible just a few years ago. However, inventory recovery is not uniform across the country. Some markets remain tight, while others have loosened considerably. Understanding your local supply conditions is absolutely critical before making any offer. Your local market and timeline matter everything here. Let's use real numbers. Say you're looking at a $300,000 home. With a 6% mortgage rate and 20% down, your monthly payment including taxes and insurance lands around $1,800. Now compare that to renting a similar home for $1,500 monthly. On the surface, renting looks cheaper. But here's what most people miss. After 5 years of renting, you've built zero equity. The homeowner, meanwhile, has paid down principal and potentially gained appreciation. The break-even point typically hits around 3 to 5 years of ownership. So if you're planning to stay put long-term, buying starts making serious financial sense. But if you're moving within 2 years, renting likely wins. So now that we've broken down the rent versus buy math, let's talk about who is actually well-positioned to buy in 2026. Because readiness isn't just about wanting a home, it's about your financial foundation. First, credit score. Ideally, you want a score of 700 or higher. That's where you'll access the most competitive mortgage rates and save significantly over the life of your loan. Second, down payment. Having at least 10 to 20% saved puts you in a strong position, though some loan programs allow less. Third, stable income. Lenders want to see 2 or more years of consistent employment history. And finally, long-term mindset. If you're planning to stay in a home for at least 5 to 7 years, buying starts making much more financial sense. Ask yourself honestly, do you check these boxes? If yes, 2026 might genuinely be your year. Now, not everyone should be rushing to buy in 2026, and being honest about that could save you from a serious financial mistake. If your debt-to-income ratio is above 43%, most lenders will already hesitate, and your monthly payments could stretch you dangerously thin. Unstable employment is another major red flag. If you have switched jobs recently, work on contract, or your income fluctuates significantly, taking on a 30-year mortgage right now adds enormous risk. Then there is the savings question. Buying a home drains cash fast. If purchasing leaves you with little to no emergency fund, one broken furnace or unexpected repair could spiral into real financial hardship. Finally, if you are living in a market where home prices are still dramatically overvalued compared to local incomes, waiting for correction could literally save you tens of thousands of dollars. Patience here is not weakness. It is strategy. Here is something most financial content will not tell you. Perfectly timing the housing market is nearly impossible, even for professionals. But timing your life? That is something you actually have control over. The real question is not just whether the market is right, but whether you are right for the market. Think about it this way. If you are expecting a new child, need more space, or just landed a stable long-term job in a city you love, waiting for a slightly better mortgage rate might cost you more in life quality than it saves in monthly payments. On the flip side, if your job situation is uncertain, you are unsure about staying in your current city, or your family plans are still up in the air, no interest rate drop makes buying the smart move. Economic conditions set the stage, But your personal circumstances write the actual story. Strategy matters just as much as timing in 2026. First, consider buying down your interest rate using mortgage points. Paying 1 or 2 points up front can lower your rate and save you thousands over the life of the loan. Second, negotiate seller concessions. In markets where inventory has improved, sellers are more willing to cover closing costs or offer credits, so don't leave that money on the table. Third, explore first-time homebuyer programs. Many states and local governments offer down payment assistance, reduced rates, or tax credits that most buyers never even look into. Finally, if you plan to move within 5 to 7 years, an adjustable rate mortgage might actually work in your favor, giving you a lower initial rate before any adjustment kicks in. Now let's zoom into specific markets, because where you buy matters just as much as when you buy. First, let's look at a buyer-friendly market. Indianapolis. Indiana stands out in 2026 as one of the more accessible cities in the country. Home prices remain relatively modest, inventory has improved, and local incomes are keeping pace with costs. Buyers here have real negotiating room. On the opposite end, Austin, Texas remains challenging. Despite some price corrections from its pandemic peak, Austin still carries elevated prices relative to local wages, and competition in desirable neighborhoods hasn't fully cooled. Then there's Charlotte, North Carolina, sitting somewhere in the middle. It's growing fast, prices have risen, but job growth and population trends suggest long-term value for buyers willing to stretch slightly. The takeaway here is simple. National headlines don't tell your whole story. Your specific market conditions should heavily influence your timing and strategy. The 2026 housing market is not a simple yes or no answer. It never is. What we have covered today gives you a real framework to work with. Nationally, mortgage rates remain elevated but are showing signs of gradual easing. Home prices have stabilized in many areas but remain stretched in high-demand coastal markets. Inventory is slowly improving, giving buyers more breathing room than they had in 2021 or 2022. But here is the truth that matters most. Whether now is the right time for you depends on 3 things working together: the national market conditions, your specific local market dynamics, and your personal financial readiness. And that is a wrap on one of the most important financial questions you can ask yourself right now. Thank you sincerely for watching all the way through, because this is not a small topic. We are talking about potentially the largest purchase of your entire life, and the stakes are very real. If this video gave you clarity, perspective, or even just a better framework for thinking through your decision, please hit that like button right now. It genuinely helps this content reach more people who need it. If you are not subscribed yet, now is the perfect time. Hit the subscribe button. It helps this channel grow. Now here is what I really want to know. Drop a comment below and tell me, are you planning to buy in 2026, or are you choosing to wait? Share your reasoning. Thanks for watching.